Hello and welcome everyone to Capital Trendz, where we decipher the latest business and investment trends in 15 minutes or less. Let us begin today's episode with a quote from former US President James Garfield. He quoted the following in the year 1841: "He who controls the money supply of the nation controls the nation."
Many a times, especially while dealing with the cryptos, you must have heard this word fiat currency. Do you know exactly what that means?
Yeah, I do. Broadly, tangible currency can be divided into two categories: fiat currency versus representative currency. Fiat currency is government backed. The value is based on the faith in the government and the economy. Fiat money is not redeemable for anything. Government is free to print more if it wishes. On the other hand, commodity backed currency is representative currency, used to be backed by gold, which is called gold standard. Value is tied to that of the commodity. Currency is redeemable to equivalent amount of gold. Money supply is limited by the supply of gold. So, how the supply of the money by the government is assured? You will hear the word liquidity in the market. That's what it means by assuring the supply. Notes and coins in general circulation, hard currency held in bank reserves, representative money that can be readily exchanged for cash, like we used to have traveler's checks, we don't have them anymore. Deposits in bank accounts that allow ready access, term deposits, mutual funds invested in the money market for a quick 24-hour turnaround, government repurchase agreements. Government repurchase agreements are like securities that can be sold and bought back a day later, or the deposits with longer notice period, like money market funds and all that. Most common way the government ensures that there is increasing money in circulation in making banks to issue loans. 97% of the money in circulation is in the form of credit.
Now that we have talked about how a government manages supply of money, what are your thoughts around recession? And the $1,000,000 question, are we going into recession?
That's I think every journalist around is talking about recession these days. The literal definition of recession is two consecutive quarters of negative or falling GDP. The economy is measured as GDP is shrinking, meaning that less is being bought and sold in the economy. This will usually lead to falling wages and higher unemployment. We don't have higher unemployment at the moment, so it's a bit a tricky situation going on right now. As more people are out of work or earning less than they previously were, they have less money to spend. They begin to save, fearing economic future, in turn having negative effect on economy, as we have lettuce prices are high right now. Demand falls further and companies may be forced to cut cost and production. A depression occurs following protracted period of deep recession, for instance, the Great Depression of 1929 to 1941. Average US economy fell up to 40% between 1929 and 1932. The healthy economy requires a good money supply. We all know that by now. A country's government and central bank play a key role in circulation of money, which is RBA or Reserve Bank of Australia and Fed in the US. Dr. Philip Lowe and Mr. Jerome Powell are their governors of these two banks. The central bank controls the supply by altering economic policies around interest rate, reserve ratios, open market operations, and quantitative easing or quantitative tightening. Whereas the government exerts control by taxation and by restricting borrowing and lending. As we all can see now that Liz Truss, the Prime Minister of Britain, is doing that. Many central banks around the world are made independent from the government in early 2000s, but there are some pros and cons to that. Commercial banks rely on the central bank reserves to support their day-to-day operations. By altering the amount of reserves and the cost of borrowing from with them via the rate of interest charge, known as the reserve rate, or base rate, or repo rate. By doing this, central bank acts as a lender of last resort. Central bank conducts open market operations, which is buying or selling of securities in open market in order to influence money supply. The objective of central bank or monetary policy is to deliver price stability, low targeted inflation, and support the government.
You did mention open market operations. What are they and what impact does it have on the money in circulation?
Yes, as we discussed, controlling base interest rate isn't the only tool central bank has to control the money supply. It can also conduct something called as open market operations, that is, buying or selling of bonds from bond investors. This can include treasury bonds or high-rated commercial bonds. When central bank buys bond, it pays printed money to these large institutional investors, who in turn deposit that money in the commercial banks, in turn increasing the overall money in the circulation. And when central bank sells the bonds to the investors, they withdraw money from the bank to pay them, decreasing the money in circulation. This phenomenon is called quantitative easing or quantitative tightening. It's going on at the moment since COVID time.
By the way, do you know which is the oldest central bank?
Yes, it's Swedish Riksbank, established in around 1668. We talked about Reserve Bank of Australia, which is Australia's central bank. Do you know how are RBA board members elected?
The treasurer appoints the RBA governor and deputy governor and the board members. The current governor of RBA is Philip Loy, who was deputy governor from 2012 to 2016. In 2016, the then treasurer Scott Morrison appointed Philip as the governor of RBA.
So the government appoints an RBA governor. Does it mean that government controls RBA?
Great question. I think this has been debated on and off since the creation of central banks. The central bank is created by government legislation, so it cannot be completely separated from the government. What we are talking about here is how much independent the central bank is or should be. The government and politicians have a short term horizon and it can lead to potential dangerous long term consequences. So even though government appoints RBA board members, the government does not set the goals for RBA. The RBA decides and pursues its own monetary policies. We have so many instances in history where too much meddling by government can lead to long term bad consequences for the economy. For example, the hyperinflation of Indonesia in 1960s was a classic case of excessive government spending. Take for example Turkey's central bank. It is formally independent, but the country's president has sacked governor after governor if they don't listen to him, and it's taken Turkey's inflation upwards of 80% plus.
Let us move forward to talk about economic indicators. These indicators government use to monitor economy based on a survey of individuals. A national statistic agency is used responsible for this survey. The four main indicators are inflation, growth, unemployment, and wages. You will hear about them a lot.
Let's talk about inflation, as it's the talk of town these days. It's easy to measure the change in price of an individual product over time. But in order to understand inflation, we use a big and diversified set of products as well as host of services for living a comfortable life, like commodities like fuel, then metal, food grain, utilities like electricity, public transportation, services like healthcare, labor, etc. So, the Australian Bureau of Statistics was formed in 1905. It calculates the Consumer Price Index, which is called CPI. So, what it does is it calculates the CPI calculates thousands of items and then divides them into various categories. The selection of these items and their weights used to happen every 5 to 6 years, but since 2017, it's been updated every year. ABS then collects these prices and calculates the change in the price and publishes this data every quarter. In the US, this data is published every month. So, fun fact, by the way, Australia only had deflation 3 times in the entire history of the index. That's more than in the last 70 years.
Oh.
In 2020, Australia recorded deflation of minus zero point 0.3. Before that, it occurred in 1998.
Did you know US Bureau of Labor Statistics was formed in 1884, which analyzes all this above mentioned data, which you right now mentioned. The next indicator is growth. This is measured by growth of gross domestic product. GDP, you hear that word everywhere. GDP is the total value of all the goods and services produced by a country in single year. Then other one is unemployment. This is the proportion of those who could work and who want to work but are not currently employed. It is measured as percentage and varies widely from different countries.
By the way, Australia's unemployment rate is at a record low, currently hovering around 3.45%.
That's really low. Wages, which is the final one. Data on wages are usually shown as growth figure. As prices rise due to inflation, wages must rise even faster in order to ensure living standards are continually improved.
Let's talk about one of the hot topics of today, interest rate or cash rate. First of all, is cash rate and interest rate the same? In layman's term, the interest rate is the amount that one is charged for borrowing money or the amount that one would get if you save money. Simple, right? But in the news, what we hear is cash rate and not interest rate. So the RBA board members, comprising of 9 members, meets every first Tuesday of each month. They decide on the cash rate target, which is used as the interest rate on unsecured overnight loans between the banks. It is often called overnight money market interest rate. When RBA increases the cash rate, the banks in turn update their interest rate to pass that cost to the customers. In 1990, Australia's cash rate was 17.5%,
Wow, that's a lot.
the highest ever. So some people say we are lucky, we are living in the age of cash rate of 2s and 3s.
How has the rise in inflation impacted our beloved stock market as well as venture capital space?
As the inflation rate rises, it brings in uncertainty. It plays a big role in pretty much every aspect of building a startup, from funding to hiring people. It slows the investors' appetite to fund startups as the money dries up. The magical valuation some of these companies had a few years back has become irrelevant. Inflation also has a big impact on the housing market and stocks. There are total 12,000 venture capitalists with 30,000 plus businesses in the world managing $6.4 trillion dollars with millions of employees working for them. Lots of numbers there.
Absolutely.
As the inflation goes up, the supply of money they invest dries up. Same equation goes for stock market as well. Institutional and retail investors don't have excess cash to invest. A famous journalist had said once, inflation is a form of tax, a tax that we all collectively must pay. On that note, let's wrap up today's episode where we try to decipher the latest business and investment trends in 15 minutes or less.
This recording is for informational purposes only and does not constitute an investment advice. Opinions expressed are as of the date recorded. Opinions are subject to change. Capital Trendz Media shall not be responsible for trading decisions, damages or a loss resulted from or related to information, data analysis or opinions expressed on this podcast. Past performance does not guarantee the future results. All investments are subject to market risk including potential loss of principal. Please read product disclosure statement before investing into any product. We are not professional financial advisors. Do not take investment or financial advice from our podcast. Always consult a professional financial planner regarding advice that suits your individual needs, which you can find on ASIC, APRA website in Australia.